Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Michael Ealy. Mike started in real estate investing in 1999. He made crucial mistakes which led him to losing everything in the early 2000s. Learning from this, Mike has since acquired over 1,000 apartment units, and due to his success, he has recently attracted the attention of some Chinese investors. So how you doing then, Mike?
Everything's great, Charles. How you been, brother?
I'm doing well. And you have a very interesting story, and you're involved in a lot of projects. So I think that the listeners are going to get a great value out of our chat this morning. And people don't know, give us a little background, professional background on yourself prior to starting in real estate investing.
So I grew up in Cincinnati, attended Tuskegee University, finished up in electrical engineering. I started off doing concerts and parties, and that's kind of how I paid for school. And then I started buying houses after graduation with no money down, the old Carleton Sheets techniques, right?
That's a name you don't hear much often.
Yeah, you won't hear it much. And I lost everything. You know, I was making $300,000-$400,000 a year, and I had to start all over again.
So what happened in the early 2000s?
Well, so I started buying real estate. Well, I was working for a job in electrical construction. I was a property manager, buying agent. And then I started buying these houses with no money down. But I really didn't have any plans. I was just buying these houses. It was great because, I bought my first two-family. I put like $2,000 down, and then I fixed the upstairs and then rented the upstairs and part of my unit, and I was living rent free. Life was great. And then I did it again. So that paid my car payment. And then I kept doing that. Next thing you know, I got about, 15 to 20 units. And then I lose my job, or I might have got fired. I'm not really sure to this day. I don't know. But then I started depending on that, and then I had a car wash, and then it all fell apart. And because I didn't have any financial discipline, I didn't put any escrows, I didn't set money aside, I didn't have the business plan. And then next thing you know, I lose everything.
So it was really not having the reserves that did it. It was, how was your financing on it? Was it fixed financing, or
I did everything. Well, as far as the houses, I did that. But as far as the car washes, I'd had a land contract rent to own deal, and I got in with minimum money down. And what really set me back, I didn't know if you knew, but nobody ever told me that it rains April and May and maybe a little bit June every day. And so naturally I wasn't generating enough revenue. And then it's kind of that old, hey, we'll take funds here from there, the old Peter to Paul deal. And you just started falling apart. But if I would have had some escrow and reserves, we probably could have made it through. But I'm happy it didn't, because I never want to do a car wash again.
How did you start to rebuild your portfolio? So when you changed your mindset and you actually had a business plan, what did you do differently, and how did you structure the rebuilding to where you are now?
Well, that was interesting. I had some motivation. Not only was I broke, I moved back home with my mom and dad, and I was 30 years old. So, and they painted my room lavender and pink, and they still had my old twin bed, the old, like on the ships where they had that steering rudder, that wheel, that was my headboard. And so I was pretty sexy at 30 to be living at home. And so that was my motivation to get up every day. But what really happened, I went back, got my real estate license. That kept me kind of attached to the market and in the game to see what was going on. And then from there, I learned what people wanted to buy and didn't buy. But I wasn't a great realtor at all.
Yeah.
Probably had like 30 deals that year and only closed on about 7 or 8. And
what year was this?
The market, I'll say 2003, 2005. Okay. And only made $13,000 a year that year as a realtor. But like I said, the great thing about it, I found out what people like, what they don't like. And I took those ideas with my previous experience, and I had some college buddies invest with me. But I found a deal, I marketed it, I renovated it, I leased it, and I resold it. I took management fees and commissions and gave them all the profits. I succeeded twice in a row where they netted like 30,000 plus a deal. And I said, I got it. I went on my own. And then I ended up finding an investor that gave me a line of credit for almost 200 grand.
Wow. Nice. That's awesome. Then you started, what kind of properties did you start with?
Start off with some simple ones, I bought some, we got the West Side in here. I bought multiple houses for in that $8,000 to $20,000 range, putting 5 to 10 in it. Quick turnovers, getting a tenant in there, renting it for $650, $750, $800 a month. They became turnkey, and then an investor would come and buy it from me, at a $15,000, $20,000 markup. I would then take those proceeds, take a little bit out to pay my bills for 2 or 3 months, which was minimum. And I took that cash and bought another house and paid my investor off. And so then that was the beginning of me owning houses free and clear, just very small ones.
Yeah. Makes it much easier with a single family house where you don't have a mortgage and you're not renting to any person that comes off the street because you want someone to cover that mortgage, even though they're probably not the best tenant to put in there.
Yeah. It was a challenge.
Yeah. So one of the deals I was looking over that you had done, and we were speaking previously about, and it's very interesting because when people ask me about getting involved with real estate, the first thing, and they talk to me about the areas, and the first thing I'll say is avoid D-class properties, right? Because and you actually made a value add play of one, which was, so this is very interesting. Tell me us about what why you got involved with this property, how bad the area was. Was it a true war zone? And how you were able to, work your business plan. What was your plan through the whole thing?
So the one reason I started in D and F, that's all I knew. I only knew those markets. I had other friends that were doing real estate, and they would be in these B and A markets, and I didn't know that. You could tell me whatever you want, and I didn't understand the pricing. In these areas, I knew what people were paying. I knew what we could get for rent, and I knew kind of what we could do to get it rented. And we were providing some quality housing. And when we say quality, we were putting tile in these low-income houses, which they didn't do that. We would put nice tile floors, nice countertops. It just didn't look like your old Section 8 low-income housing. If it was in another area, people would love to live there. But one of the war zones I bought was a 28 unit. Literally, I could come out and literally they were shooting.
Wow.
But I used multiple strategies. I really didn't know how to lease it, but I used what they called guerrilla marketing at that time. Putting your flyers out, putting in stores, going in different areas and just posting up your thing. Because most of those people, they weren't using the internet at that time. Also, I met some people that were experienced in real estate that leased in this type of area, and they worked with a lot of different agencies because all these agencies help people, whether it's for elderly, for some type of disease or mental abuse. All those people need places, and they had subsidies that'll help pay for that. And so I went in, fixed them up, called these agencies, and they loved me, and they just started throwing me people, and they were paying rent. Next thing you know, I got 85, 90% occupancy in these D plus areas because I knew if there wasn't no type of subsidy, there was no way I could be successful. I did the things people did not want to do.
That's a lot of work.
Yes, it was.
Yeah. Anything when you have to deal with any of the agencies, I mean, it's just.
It was a grind. There was a much easier way to do it, but it's where I got started. I appreciate it because I know how to control my costs. I understood people, understood their situation, so I could relate and become successful. So when I did finally make it to C or B property, I thought I was in heaven. I thought it was the greatest thing since sliced bread.
So what happened with the with that D-class property that you ended up netting $1 million off of? What was the major turning factor there that allowed you to make that profit? Was it the gentrification in the area? Was it something, keeping up rent?
Now, quite frankly, the reason we made $1 million on that one, it was strictly the market. When we first found that property, we found it for about $220,000. That was about $4,000 a door. We knew that if we put about another $4,000 a door, we could be all in for about almost $400, and let's say flip it for $600. That was just my feeling. This was before I was really taking any CCIM courses and understanding cash flow and depreciation, internal rate of returns. And so when we did that, I really looked at it as like, man, you know what, let's just flip it. But one of my partners said, no, man, let's go for it, go after the property. So we fixed it up, we rent it. I called the agency. Matter of fact, I only had 8 tenants. It was a 48-unit building, only had 8 tenants. I had another 8 units, gutted down to the stud, and the rest remaining was vacant. I went to one agency, and with less than 30 days after I acquired the property, they took my entire building.
Wow.
And they guaranteed my rent for a year. So I was off and running. It was my first home run that was not so much an easy run, and we had a lot of issues going into management, but I had a great team. And because of that, we're successful. But one of the things I noticed when we were buying it, I noticed the transfer history. I was looking at, I saw what people were paying $1 million and $1.3 million and $1.5 million. And I couldn't find who would want to pay that. And do you understand this area you in? But the market was down in 2008. That's when, we had the Great Recession. Everything was down, pennies to the dollar, and we just attacked it, and we were aggressive. And then we understood cash flow and cap rates. And typically in the area, at least in the Cincinnati area, properties like that will sell at a 10 cap. At the time of the market, it went down to an 8 cap. And there you have it. We sold it we had, 1.5, 1.6. We were all in for 400. We had a concession and netted $1 million.
After 6 years of holding it?
6 years of holding it, yes.
Wow. Nice. So speaking about cap rates and how everything changes, obviously, in that situation, how is your company handling the current low cap environment? And to listeners, just so they understand, if low cap meaning lower capitalization rate, in other words, just high prices where we are now.
No, honestly, I think some people would be upset, but I love it. This is great. This is awesome time. For one, with the lower cap rates, that means it's a seller's market, and sellers are getting big money for what they sell. So number one, when they're selling projects, we're getting top dollar. But one of the great things about this sudden increase, because of inflation, because of utilities, costs, so therefore the rents have jumped up as well. But what the real thing is, these sellers, they've held on so long for these properties, they just wanted to get realized, but they didn't realize they did not maximize the true rents. For example, in Cincinnati, for years, we were stagnant in rents. Our 1 bedrooms were renting from $400 to $500. But in this last year and a half for C properties, it's jumped from $400 to $500 to $650 to $750 for a 1-bedroom. And for 2 bedrooms, we were in that $600, $650. That has now jumped up to almost $923 for a C property. So these people are selling, they don't maximize the rent. They say, well, I can sell at a 7 cap or 6 cap. I'm saying, great, sell it. They did all the heavy lifting, they renovated it, and then I come in and buy it at their so-called 7 cap. But because they didn't realize the rents, I really bought it at a 9 or a 10 cap. And all I do is push the rents and then resell it at a 6 cap. And you made anywhere from $300 to $1 million difference.
So really, you're completing the value add process to getting it to its full potential, where they've left some money on the table and you're picking that up. So
there you go. And we don't believe in leaving any money on the table, brother.
I mean, that's what you have to do now to do a deal. I mean, you can search for deals, but just like when we're looking for deals, I mean, the everything has just gone crazy. I mean,
yes.
It's just, I mean, just when we look through on broker sending us stuff and you're like, that is completely nuts. And it's, you have to really look through hundreds of properties to find something that has something that you can work with. So that's interesting. So another thing you guys are involved with is doing a lot of hotels as well, in addition to apartments. Now, you just closed on a hotel in Columbus, 347 apartment units as well. How did you find that deal, and what are your plans for it?
Well, and Charles, just like you were talking about, deals are hard to come by because of the market. They're crazy with it. Fortunately, we have established relationships over a period of time. And I wouldn't necessarily call them my best friends, but these are friends. We hang out, and we actually did deals together. So when a deal comes, it's kind of like they give me first rights. They put it in front of me. They let me analyze it before it hits the market. And so I'm able to get into that investor ahead of time before it becomes a competitive market, or before they send it out to like hotels. Now, they do their market completely different. It's kind of, they got their pocket investors and they go to, but then after that, they go to a conference and they market it out there, and they'll sell them just like that. Because we have these relationships, they bring them to us, we get to analyze it, and then we decide to buy. And we got some great undervalued. For example, there was one in Little Reno. It was one of the first deals I was looking at, and they offered to me at $20 million. And at the time, I was low on cash and low on investors, and I think it was a $7 million call. And if I would have did that, I'd have been stuck to this deal for the year. So I passed, and it went to the conference, and they ended up selling it for $24 million.
Wow.
So that's kind of the things. But what I plan to do with this hotel, I don't know. We're kind of, it was in a depressed market that came back. Our initial goal is just to fix it up, renovate it. We'll do what they call a PIP, Property Enhancement Program. Instead of calling it renovating, they call it PIPs. And they come up with a complete market plan on how you're going to remarket it and how you're going to redesign it. And then, we want to increase the ADR, which is the average daily rate, which is compared to your monthly rent. And we want to push occupancy by doing a lot of sales in the local area. And hopefully we increase that. Maybe we sell in 3 years a hold. These 346 units, they're in a great, desirable neighborhood. Me personally, but we have partners and investors, I would love to keep it because that's something easy to manage forever. That's something easy. But there was so much value there. I don't know. I think I may have to sell for my investors. I mean, it was a deal. We're going to be all in for 24. At minimum, the value should be $32 million.
Wow.
But I think we can get to 42 to 45 million in value. I mean, we got one building, they rented for 900. When we're done, we'll be leasing those out at 1,500 a piece.
And when was the last time they were updated before you bought it, the units?
probably early 2000, but let's say every time they turn over, right? If it's bad, they update it. It's just
early 2000s isn't that old though. You know what I mean?
Yeah,
That's
exactly.
a lot of value just for adding
not
on.
really. It's just not really up to par. Like, the white cabinets and the granite countertops or the newer windows. So we're going in and do those things. And there's a waiting list for that area. I mean, these are just great areas that really the layout doesn't match the area and the income.
Wow. Okay. Now, just one thing on the hotel, just for my own knowledge, how does that work? Where are you bringing in like a nationwide service provider that puts their name on it? Is that how that works? Or how do you brand that and market that when you're going through your business plan, the PIP?
So for me right now, I'm focused on existing hotels. So they already have a brand. And our group, the hospitality group, subsidiary under Nassau Investments, we like to focus on the Marriott brands and the Hilton brands. Okay. Those are kind of your top brands and kind of not your full service brands. We like to do like the Hampton Inn, the Courtyards, something equivalent to that. Now, there are the IHG brands, which is Intercontinental, like Holiday Inn Express. There's the Choice brands like Comfort Inn Suites. And those are all good brands. Quite frankly, Choice and IHG, their fees are much cheaper. So even though, let's say the Marriott Courtyard, right, an example, has $4 million in revenue, but these Choice and IHG brand has 3.2 million in revenue. So quite frankly, though, when it comes to the NOI after debt, you're both making the same amount of money. All right. They both make the same because of the fees. But the biggest difference, and they pretty much cost the same to renovate and build. But the biggest difference is when you go to sell it, one's going to sell at 1 to 1.5 cap rate better than the other. So the Hiltons and the Marriotts versus the Choice and IHG are going to sell at a higher end price versus the other one.
Interesting.
So yeah.
Interesting. So I wanted to talk about, since podcast focuses on international investors, and you've started to work with Chinese investors. And how did that start? I mean, how did you start working with them? And then I also want to speak about one of your EB5 projects you had going on.
Okay. I think Harvey McKay said it best in his book, Swim with the Sharks. They asked him, "Do you believe in luck?" And he said, "Yeah, the harder I work, the luckier I get." And I think that was kind of one of those things. I got lucky and I had some God with me. One of these Chinese investors was looking for some single family houses, and they ended up buying a small portfolio from one of my previous partners in a low income area and paid full retail price. I was like, oh my gosh, you got to introduce me to them. Like I got something to sell. And so he introduces to me. And then so we start selling off some of my properties to him. Now already cash flow and stabilized, but they were in better neighborhoods. And then after a while, became friends, hanging out together, celebrating the Chinese New Year's together and everything. By the way, that threw me off. I don't know if you ever been, America's had me spoiled rotten. I'm thinking we're going to have this standard Chinese food, the fried rice and shrimp with chicken and beef. And then I go to this dinner and they got chicken feet and cow tongue, duck tongue.
I was in Hong Kong for 3 weeks for my fiance's work, and you're walking down the street in Hong Kong and it's just hanging like ducks, and like you can buy, like there's like you can put your hand in and grab like a crab. Like it's nothing like the United States Chinese food where you're having like general town, stuff like this. But so that must have been a pretty interesting event too. When you go there and you're like, yeah, I'll just have some more rice, you know?
Yeah, and they gave me a lot. I don't know if you got a chance to taste it. The motais, the Chinese white rice liquor.
Oh, okay.
Oh, that's awesome, man. But don't drink too much. We had a lot of red-faced people at that dinner table. But yeah, so what happened? I established a relationship. So now, whenever a Chinese investor calls and wants to be in the Cincinnati market and they spending like over $1 million, they call because we got a small population of Chinese. And then you got another smaller population that deals with real estate. And they call about 3 or 4 people. And whenever they call one of my friends, they immediately call me. And they say, you got to sit down with Mike. He's got multiple projects and we could put you together. And you mentioned EB5. Now, although I wasn't a part of this, these people, my first Chinese group, they actually were in a failed EB5 project.
It was construction?
It was construction. They were looking to build some apartments and renovate. And I actually happened to know all the players involved. And it was just a messy situation. They wanted to kind of move on from it, but they still had money left in the U.S. They gave up on the idea of the green card, but they wanted to still invest. So I introduced them to, put a couple of deals in front of them. We tried a few small ones, 300,000 here, 400,000. And within a 7-month period, I flipped their money twice. And then they were comfortable. We were comfortable with each other. Then they ended up giving me the full $2 million. And I went and bought a hotel and some apartments.
Interesting. So what were their goals? And for that specific initial investors that you worked with, what were their goals? And then what was the goals that you've had for other investors, say Chinese investors that have come to you? What are they trying to do? Are they just trying to, obviously make money, but is more of their goal on preserving capital? Is it just getting into safer assets than where they are in their home country, or what,
Everybody's a little different. First of all, it depends on what level of investor you have, right? Mm-hmm. So naturally, if you had the EB5 person, they're more concerned about getting a safe product, a safe project that they can obtain their green card, right? Mm-hmm. Then you have some wealthy investors who are like, hey, I just want to be able to own some real estate in the U.S. It's kind of like buying Gucci, instead of Polo, they got Gucci and Louis Vuitton. Then there's the investors truly like, look, I want to grow, sustain wealth. If anything would ever happen over here with all this, the way the government is structured, I can always have my cash and come to the U.S. And so because of that, some have different expectations. EB5, they're expecting, kind of that 3 to 5% return. Then you have other investors, they just looking for the standard 8 to 10%. But for me, I do 8 to 10% in my sleep. My goal is to get my investor double-digit returns, make sure we return their principal, and give them a piece of equity as long as it's in the bigger projects. And so we like to get them anywhere at minimum 10%, but typically we hitting that 12 to 15%. And then at minimum, we want to give them, about a 18% internal rate of return, but that generally surpasses 20% plus.
Okay. Wow. Before we shift to your company, just finishing up with international investors here, when they come to you, do you see that a lot of them already have their entity set up, their everything all set, ready to go, or are you kind of coaching them through the process of getting started before we even start looking at properties?
Now, some of the entities, sometimes they do have some. Fortunately, I'm aware of how to set it up, so I will do that for them. Setting up an LLC is not a problem, but sometimes creating that bank account can. So a lot of times, at least in my experience, the investor already had somebody in the U.S., and so they created a bank account for them. Yeah. So that's normally how it happens for them.
Yeah. If when investors come to you, say a Chinese investor comes to you and they hear this and they want to start, or they're interested in reviewing and researching, what are the first few steps? An international investor, say from any country outside the United States, comes to you and says, what would you tell them to do to get started? Like, what's the first couple things you're doing before they even start looking at properties? Okay,
I'm about to do a shameless plug. I don't have it. Read my book. No, no, I do have a book coming out. It's kind of, for me, I kind of go through an education process for them. And on my team, I have, other Asian, Chinese friends that are actually partners. And we sit down and have kind of intimate conversations on their goals and what they're looking for, and making sure they understand what it is to be a part of the operating agreement and obtaining debt or getting a preferred return. And most of them do, because they're at least the ones I've been dealing with are a little more sophisticated. Now, I do have some small investors that are up to capacity. And so those smaller ones, I suggest you just do a smaller single family house or two, just to get a feel for everything before you jump into this larger syndication.
Okay. Yeah, that's a great way of doing it and get an idea of how everything works. And so tell us about your company, Nassau Investments. And you guys are involved in apartments, hotels. What else do you guys do? We have a little about the services that you offer, but.
Yeah, so we got to update that. But now, I started off with single family homes and then got into small multi-units. And then I did offer property management services. Back in 2007, when the recession was there, I was buying mortgage notes at pennies on the dollar. And really, that's where I became stable in the market. Like, literally, for once in my life, I didn't have to worry about hustling to find a new deal to pay the bill. We made enough money and we had enough cash flow coming in that now I could focus on bigger projects. And my goal was to get into multi-units and larger multi-units. And we've been successful through multi-teams and partnerships. And now our focus is strictly hotels and apartments. Just this year, we're already at 40 million in deals. And we just got another 500 units thrown at us, and another 500 is coming. So honestly, I think we'll do 80 million just this year.
Wow.
It's been an amazing ride, and I'm enjoying it. And then our hospitality group, I put an amazing team. I studied the market for 5 years over a period of time before I jumped in, and I put this amazing team called the hospitality group, and it incorporates the Sat family, who's I've worked with for some time, which developed every single one of their hotels. They have over 16 hotels. They got it's about 200 million in assets. And then I bought some operators who are partners as well, Commonwealth, Paul and Brian. They have over 30 years in the business, from international to the Hilton brands. Matter of fact, one of them was responsible for going out and developing over 400 hotels across the U.S. And combined together, the hotel group, where we own and manage over 1.5 billion in assets. And so we plan on expanding that, a couple of hotels a year.
Awesome. So tell us about your book, and then also how people can get in touch with you.
Okay, so got a book coming out shortly. So we're going to keep you. It's called How I Went From Broke to 1,000 Units. And we'll talk about all the great things that happened, how I got there, the failures, the successes, and how I gave back. And the goal is to actually teach some other people to become wealthy, truly to be millionaires, and to give back and give scholarships to, my goal is to give scholarships to children that have been adopted or wards of the state. I want to give them a full ride. And by training and educating people, this is one of the goals I want to accomplish. But to get in touch with me, you can find me at Bigger Pockets or LinkedIn. That's Michael Ealy, Ealy, or always keep in touch on all the deals. If you're interested in investing, being part of a syndication, or you want to be an active investor or a passive investor, just go to NassauInvest.com. That's Nassau, Nassau, Invest, INVESTS.com. And you can reach me there and we can dialogue some more, set up some meetings. International, we have interpreters to speak fluent Mandarin and from Shanghai, where I often visit and play soccer, by the way. So you can catch me there.
All right, sounds good. So what I'll do, Michael, I appreciate you being on the call. And then what I'll do is I will put everything together, all the links and the emails and the URLs, everything that you've mentioned, we'll put into the podcast notes and YouTube notes. And it'll be easy for anybody that wants to reach out and learn more about Nassau Investments to do so.
Hey, thank you so much, Charles, man. I appreciate the opportunity, brother. I really appreciate you, man.
Yeah, thank you very much. Have a great day.
All right, take it easy.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Harborside Partners Incorporated exclusively.